should probably begin. We're 5 minutes after start time. Welcome. My name is Graham Knight. I'm currently the Acting Director of the Gilbrea Centre. And it is a pleasure for me to introduce today's talk in the Gilbrea Centre's series on contemporary issues in aging. Dr. Byron is a professor of economics here at McMaster. He is also director of the Research Institute for Quantitative Studies in Economics and Population, and the academic director of the Statistics Canada Research Data Centre here at McMaster. His research, particularly his recent research, deals with population, aging, and the relationship to health, healthcare, and income. His recent research has appeared in, among other places, the Canadian Journal of Public Policy, the Canadian Journal on Aging, and the International Journal of Health Services. The title of his talk today, What Happens to Income After Retirement?
Thank you. Well, let me start by saying that the topic what happens to income after retirement is one that you'd think would be of interest to most anybody who's either retired or approaching that state. But many economists would think that's not the right question to be asking at all. So I'd just like to spend a moment on that to indicate why it's probably the right question. The reason that economists often would think you shouldn't be talking about income after retirement, but rather you should be focusing on well-being after retirement. How well off are people after retirement? And that's not necessarily income. And the way economists tend to think of it is something along the following line. If we put age along the horizontal axis, and along the vertical axis we measure your income over time, then you have very little income when you're young, but your labor income, at least from working, tends to go up and might look something like this over your career. And if you suddenly stop working, it's just going to drop to zero. If you phase out a bit, it'll phase out and look something like that. So if this is your, we call it W for your wages over your lifetime, year by year, what you perhaps are more interested in than your wages is how much you get to consume, your expenditures, how much you get to eat and clothe and do all those other things with quality housing. So your consumption profile might look something like that. And you'd prefer to have your consumption relatively smooth, even if your income goes way up and then way down. And indeed, your income might jiggle around a whole lot more than that as you age and lose a job or whatever happens. It takes a little while to get another one. So the idea here is that economists tend to focus on then is your consumption profile as a better measure of how well off you are, at least in an economic sense, how well off you are, better measure than your certainly wage income over time. And so somehow or other, individuals would want to save enough or have enough put aside when they're in their surplus years, if you like, that they're going to be able to eat when they're no longer working, when they no longer have that income. So the focus would tend to be more on the consumption side than on the income side. Now, the problem with that is that consumption is notoriously hard to measure. It's much easier to measure income. But beyond that, on the income side, there are ever so many ways of ensuring your ability to consume once you're beyond the working years. You could have saved, and this is suggesting maybe you saved and then you had it, but maybe you weren't an active saver. Maybe, however, you worked for some agency, some company, that caused you to contribute to a pension plan, okay? Or contributed to a pension plan on your behalf, in which case you might have foregone earnings here, but you got a benefit over here. You got an income stream that allowed you to continue in your consumption. Or government comes along, okay? when the government makes payments to people who are old. We've got old age security, we've got guaranteed income supplement, and we've got Canada pension plan for people who at least had some working history, or who survived somebody who had some working history. So we've got all those different possibilities. And the thing that I'm going to focus on here then is the income after retirement rather than the consumption. And part of the reason is that it's much easier to measure income. But the other part of it is that there's a lot of evidence that people's consumption tends to follow their incomes, even if it's not just wage income. It follows their incomes, including whatever other sources of income they might have, other than earnings from employment. And there are quite a number of other reasons for that too. But measures of what happens to income after retirement are of a lot of interest, and they are the ones that are usually focused on. So that's what I'm going to talk about. Let me just say before I go any further that most of what I'm going to say here is joint work with Ross Finney at the University of Ottawa, and this is going to be based mostly on Canadian data, but let me put it into a little bit of international perspective. Here we have income replacement percentages across OECD countries. And these aren't all the OECD countries, it just gets to be a little bit too messy if I do. But here's the OECD average, 34 countries. And what this says is that across those 34 countries, public income replacement plans, okay, plans that transfer to people who are eligible by virtue of age, might be eligible by virtue of some previous employment history and so on. But they get that much from public plans. In Canada, that means old age security, guaranteed income supplement, and the Canada pension plan, and if you're in Quebec, the Quebec pension plan. What it says in the OECD as a whole, that 60% of income is replaced, on average, 60%. In your first couple of years after retirement, you get 60% of what you had before you retired. Okay, that's the replacement ratio. And I'm going to focus quite a bit on replacement ratios. Here's Canada, down here, and it's relatively less generous. It's closer to 50% of replacement. Now, let me focus your attention here. That's for the median person. Okay? So the person halfway through the income distribution. Half of people have lower benefits, half get more, but this is the person in the middle, 50% replacement. Now, there's a big difference in some countries, depending on what your income is. So if you were a low income earner, then this is what happens. Okay, in the OECD as a whole, you get rather more than the median replacement rate. If you're in Canada, you get a whole lot more. You get close to 80% if you have half the average wage when you were working. Okay? So it's in Canada, it's skewed in that direction. What if you're a really high income earner, at least relatively high? Well, here it is for Canada, and you see it's relatively low, about 25% income replacement. That's for people who have 1.5 times average earnings. An individual with 50% greater than the average earnings would get a income replacement ratio of about 25%, including all those things I said, Canada pension plan, old age security, whatever entitlement to the guaranteed income supplement. And finally, what about the person who has just average income over that whole period? Well, now I filled it in with average income. And here in Canada, you see the average income replacement ratio is somewhat lower than the median. It's a bit over 40%. What I'd like to point out is how this differs so much across countries. If we go up to, and these are ordered by medians across here. Let me just go back a bit. Ordered by medians. Okay? So from the lowest to the highest. So in Japan, the replacement rate for the median person is pretty low. In Iceland, it's over 100%. So you can hardly wait to get old if you're a median income earner. You're going to be a lot better off then than you were working. Greece is very high, Luxembourg's very high, and so on. You can see the ones here that are very high. Notable among these, I would point out, is Greece. You've heard about Greece in the financial news recently. You've heard about Spain in the financial news. And I would point out here that in Greece, it doesn't matter what your income level, you get an income replacement of close to 100%. In Spain, it doesn't matter what your income level, you get an income replacement in retirement of close to 80%. Now that might seem a great thing to have if you're in the situation of benefiting from it, but it's obviously costly. From a social point of view, it means that people in those countries have to pay very high taxes. And if the whole system isn't working smoothly, as for example it is in the Netherlands, where people again get pretty much the same high replacement rate no matter what your income level, unless the system's working very smoothly and people actually pay their taxes, and people in the Netherlands are very good about that sort of thing, then you get into financial problems. And you get into very serious financial problems. In Canada, we're in a very different situation. The income security, this income replacement rate in public plans, is very highly skewed to low-income people. So if your income level is relatively low when you are working, you're going to get a replacement rate that looks like about 75%. If you're a median person, an average person, you get about 40%. If you're at 1.5 times that, you get about 25%. So it's not a very, relative to international standards, it's not a very costly system. It costs a whole lot less to run a system like that, where you transfer to the people who are poor through the tax transfer system, and you don't transfer so much to people who are better off and don't need it. Of course, they still get county pension plan benefits, but county pension plan benefits are capped at 25% of earlier earnings. You can't get more than that. So that's sort of an international context for this in the international setting. Now, let me go on. What we're going to talk about here are three things. How much does average income drop in retirement? Nobody will be surprised to hear that for most people it drops, it drops very bad. But as we saw, for some low-income people, it doesn't fall. How much do the level and composition evolve over the retirement period? So you retire. What happens to you 10 years after you retire, or 20 years after you retire? What's the experience that's out there? And finally, how does income in retirement vary with income and employment at prime age? Now, the reason I'm focusing on that, it will become increasingly evident as I move along. The records that we have are longitudinal records. We can follow the same individuals over time for a whole lot of years. And following them over time, we can see what their income situation was in prime age. We know where they lived in prime age. We know a little bit of what they did in prime age, but not a lot. Only what was on the income tax returns. And then we can see how that impacts people once they retire and once we get to that point. So that's what that third part is about. So what's the basis for the analysis that I'm telling you? Well, it's based on the LAD. The LAD stands for Longitudinal Administrative Database. This is all tax returns, or at least it's 20% sample of all individual tax returns. The database starts in 1982, and then it's updated, so there's a 1983, there's a 1984, and so on. This goes up to 2008, and the sample is augmented every year. At the moment, it goes up to 2008. At least what I had went up to 2008. It might go up to 2009 now. It's always a little bit behind, of course. Then the sample is augmented each year, and it's a representative sample of all tax filers. And almost every adult in the country is a tax filer. So it's really 20% sample of the population. So it's a very large sample, and it can give you, there are lots of detail for analysis. Now here's what we do. We're interested in what happens to income in retirement. And that's the focus. What happens to income in retirement? So we find it, we decide we're not interested in anybody before age 50. We're only going to be able to follow people from age, whatever age we choose, until 2008. So the file starts in 1982. If we go to 2008, that's 27 years of data. So if we start at age 50, which seems a reasonable age to say you haven't retired before 50. Nobody retires before 50 by assumption. So we're not interested in you if you do. So we'll start at age 50. And we'll define people by the year in which they reached age 50. So we'll focus on people who reached age 50 in 1982. And then we'll focus on people who reached age 50 at a later year, and we'll just jump ahead 5 years and take it as 1987. So we'll take everybody who reached age 50 in 1987. We can't follow them for 27 years because the data doesn't go that far, but we can follow them for 22 years. Okay? So we get a lot of information about each of these individuals. And we can follow each of these many thousands of individuals, 20% of the adult population of the country. We can follow them for as long as the data period remains. So, first point then, we pick people who are age 50 in 1982, follow them for 27. Pick people who are age 50 in 1987, follow them for 22 years, and so on. Do that for people who reached age 50 in 1982, 1987, 1992, and 1997. Now, the people who were 50 in 1997 are pretty young for retirement purposes, but some of them have retired, and we can see at least the early years of their retirement. Now, the first question, and this is a practical, big practical question, how do we define retirement? Well, what we've done here is to define it, since all we know about people is their incomes, and we know all sorts of information about their income. Everything is on the income tax return. We know about their income. So in particular, we know whether or not they have income from employment, including self-employment. So we define retirement in this way, that in order to be retired, you have to have had a drop in income from employment. You have, first of all, you have to have been attached to the labor force when you were 50 to 52. If you weren't, if you didn't have significant income at that time, then we're not interested in you. You can't retire if you weren't working in that sense. So it's only those people who had significant income at 50, 52, and then we define retirement as having employment income no more than 10% of what it was when you were 50, 52. Once you reach that threshold, and you keep at that threshold for 3 years, then you're retired. Okay? That's our definition of retirement. Now, you might not define retirement that way. Teachers often quit teaching at age 55. They say, I'm retired, even if they have another job, and earn a whole lot more than 10% of what they earn when they're teaching. They still call themselves retired. Okay? But they wouldn't be retired by this definition. They would still be in the non-retired population until their incomes fell to that criteria. Please feel free to stop at any point. Okay, so what we do then is we define retirement that way, and we analyze how the sources of income change from age 50 on through the whole period as far as we can observe them, and that is to say to the end of 2008. And we can do that by age of retirement. So we can classify people who retired when they were 53, 54. You can't retire before you're 53, okay? Because we have to have 3 years of low income. So you can't do it before you're 53. And then you can retire at age 54 and so on. And we focus on those 4 cohorts as I mentioned. So let me first show you how we come up with, what the age patterns of retirement look like. Okay. Here they are. This is the percent of the cohort, 1982 male cohort. Okay, so these are the males who reached age 50 in 1982. And And this is the percent of them that have ever retired by our definition. Okay? So all those people who were age 50 in 1982, 10% of them were retired by the time they were 56 or so, 56 and a half. 50% of them were retired by the time they were about 63. And by the time we get up to here, by the time we're up to 76, about 85% had retired by this definition. Now, retired means, in this case, that they had ever retired. They didn't. I'll come back to that in just a moment. We can then calculate from that the percent who retire at each age. Okay? And not surprisingly, we have a big peak here of people who retire at mid-60s. Really, that's 65. We call it 66 because it takes us a year to determine that they have retired. So we know when they reach 66 they retired. So about more than a third, almost 40% of males in that cohort retired at that age. But about 15% retired at each of the ages 60, 61, 62, 63 as well. Now, finally, let me just say here's perhaps a more standard definition that you would think of as retired if you're looking at the population. So they're retired and they're still alive. Okay? Whereas this first one back here, a number of those people retired at some point but died before we finished watching. Here, it's limited to those who are still alive. And you see by age 75, 76 here, about 95% of those who are still alive have retired. So there are lots of them, there are 5% of 75, 76-year-old males who are still earning at least 10% of what they earned when they were 50, 52. Okay, now let me look at the income profiles of these people. This first profile that I put up is for this 1982 cohort. And these are people who retired when they were 53. When they were 53 years old. This is how rich this data source is. So we've got the income profile from age 50 through to 76 for people who retired when they were 53 years old, males. And this is, they were 50 years old in 1982. So they had to start with having fairly high income at age 50, but that income fell off sharply on average and they retired. They got down to no more than 10% of it. But this is their total income here, remember, not just income from employment. And then we see that that income actually goes up a bit later as they age. So here it is, age, time passing, and they get older, but all of these people retired at age 53. Here's what happened if they retired at age 54. Here's what happened if they retired at age 55, 56, and all those other ages. Okay? So there's a whole profile here. Everybody in this picture was age 50 in 1982. They differ by the age at which they retired, okay? From age 53 out to age 73. Now, I don't know how much you're used to looking at three-dimensional figures, but let me just explain. This is a lovely figure. Okay, I really like this figure. What it shows us is how much income these people had, what their income profiles look like over age. Now, you'll notice, not surprisingly here, let me just back up a little bit. Whoops, back up. You'll notice that their incomes drop very sharply at the time of retirement. Now, that's not surprising, is it? Isn't that what we expect? You retire and you no longer get income from your employment, so your income's going to drop. But I observe here that it not only drops then, but it stays much lower than when you retire. Now, if we continue on with all those others, we see that that drop occurs when people retire. Okay? At all ages, it doesn't matter the age at which you retire. The income drops a whole lot. Furthermore, before you retire, the income plateau here across a wide age range, which includes almost everybody who retires, from mid-50s to mid-60s or late 60s, that's pretty flat. Average incomes are pretty flat, no matter when you retire there. And then once you retire, retirement incomes are relatively flat as well. Now, if you retire at still older ages, where there are relatively fewer people retiring, they have higher incomes when they're employed, and they have higher incomes when they're retired. But we don't have many years of observation of their retirement for people who retired when they're in their 70s.
I would have suspected that around 65, you would have seen an increase when they start getting old age security or collect their CPP.
That's what we get out here. Is
Oh.
once we get into the 60s, you're collecting that. You know. I mean, even if I go all the way back here, even if we go all the way back here, you see we've got this increase at age 65, because that's when CPP kicks in, or at least OAS kicks in, and GIS, and maybe CPP if you opted to wait.
And so is the increase on the 70, 72 of when people get their RRSP money out?
I'll come back to that.
Okay.
Okay, so everybody understands this picture? You all think it's a marvelous picture. It's really a phenomenal picture. Okay, now the question to be posed is, what is the measure of income replacement after retirement? Now I'm going to point out to you something that's not common in their literature at all, and that is that how well off you are in terms of income depends very much on how you measure. A standard measure is to look at income maybe shortly after you retire as compared to shortly before you retire. So maybe 2 years after relative to 2 years before. So along the axis here is not age, but age of retirement. So people who retired at 54 get a pretty low replacement rate 2 years after they retire as compared to 2 years before. They were getting only about 35%, which is, not generous, but standard. If you waited until your later 50s, you got a higher proportion, and then if you waited until quite late 50s or into your 60s, you're getting around 60 to 70% by that standard. But let's take a different measure. Suppose we compare your income when you were 65, 66, relative to what it was when you were 50, 52. So relative to prime age. So just a different measure of income replacement. Look, it doesn't matter when you retired. By 60, 65, 66, you're getting 60% replacement. That's a whole lot more generous. So these people who are retiring when they're 50, 54, 53, 54, 5, early retirees, appear not to be doing very well relative to where they were, but by the time they're in their mid-60s, they're doing pretty well. Okay? They've got 60% replacement rate. They're doing just as well as people who retired in their 60s, in fact, a little bit better. Now let's take one more measure. This says how well off are they when they're 70, 71. And again, it's about the same. It's around 60%. A little bit lower the later you retire, but it's not much. It's pretty flat. And then we have a final measure here for this cohort. We go all the way up to 75, 76. How well off were they when they're 75, 76? And you see that all of these numbers sort of center around 60%. So the short-term measures here are a little misleading. I call this first one the short-term measure. The other measures, as compared to your income when you're in prime age, by the time you're in your mid-60s, your early 70s, your mid-70s, you have an income replacement rate of about 60% of what you had at prime age. This is for males, just males, not whether you're married or it's all males. Okay? All males who are 50 then, and it's just their income before and after. Okay, now let's look at sources of income. Income here is classified, we can classify it into two types: transfer income and non-transfer income. Transfer income, I mean what you get from the government sources. So that's Canada Pension Plan, Quebec Pension Plan, Old Age Security, Guaranteed Income Supplement, Disposal Allowance. It applies to women, almost always women, 60 to 64, not yet eligible for GIS and OAS, and social income, which is directed to low-income people, and then non-transfer income, which includes income from employment, RRSP income from investments, from private pensions, and anything else in the residual category. So, what does this look like? Well, here's another superb bit of graphics. Here's what it looks like. This is for somebody who retired at age 56. So the age of retirement is 56. So mid-50s, a fair number of people retire in their mid-50s. A lot of them are teachers. Now, this is the income from employment. That's what it says up here. Income from employment. So remember our criteria. Your income had to drop so that it was no more than 10% of what it had been when you were 50, 52 in order to be classified as retired. And this looks as if it satisfies that, because as these people age, this is the average over here, but as they age, first of all, their income dropped sharply when they retired, and then it stayed low. Their income from employment stayed low thereafter. So where did their income come from? Because we saw they had a fair bit of income, got up to 60% of what it had been there. So where did it come from? Well, all these usual sources. RRSP. That's pretty minimal, isn't it? Not a lot of RRSP income. And furthermore, you'll notice if you look carefully, it's a bit higher early on and it sort of peters out. Here's income from Guaranteed Income Supplement, Disposal Allowance. It sort of bumps in at the at 60. Here's the disposal allowance part. These are some men who are married to women who are old enough to be eligible for OAS, but they're not yet there themselves. So they're getting a little bit here, and then GIS clicks in, and you'll see it dominates RRSP income, and it dominates employment income for this group. These are people, men who retired when they're 56 years old, remember? Okay, but it's not terribly generous. Here's social income. Okay, sort of a low stuff there. Here's something called other. Now you'll notice this wonderful peak. This other income includes an incentive to retire. And you'll notice that that peak occurs at the retirement age, 56. So these are people who, some way or other, were bribed to retire or took a retirement allowance at that point. And it's substantial. This is just the average, so there are lots of people who didn't get it. Those who got it sometimes got a big amount, and there it is. Investment income. Well, most people aren't going to eat a lot of food with their investment income. On average, that's pretty low. Here's old age security. That's much more generous than their investment income. It accounts for more of your income. Here's Canada Pension Plan. Kicks in at as early as age 60, bumps up to age 65 when a lot of people wait until they're 65 to take it, even if they retired early. And finally, here's private pensions. Private pensions really dominate for people who retired at 56. And then finally, if we put it all together, here's your total income. So this total income here was much larger than just employment income. Sorry, was a bit larger than employment income when people were 50, but not a lot larger. And then as we move through time, and particularly after retirement, which is right here, this is age 56, we see how the sources of income change. And we see that people who retired at age 56, by and large, have fairly generous pensions. That's their biggest source of income, and it's sustained over time. Now, what about people who waited? Well, here are people who waited until 61 to retire. They have profiles that are generally rather similar. But you'll notice a big difference here in this retirement pensions, private retirement pensions. as compared to this big block here, these are a whole lot lower. And their other sources of income are somewhat bigger, but they get less private pension. Might have something to do with why they waited until 61 to retire. And finally, here are people who waited until 66. Wonderful graphics. So you see, they have pretty small pensions relative to people who retired early private pension income. But they have not far from the same level of total income. So it almost looks as if people are doing a certain amount of planning, looking ahead and trying to get things right. Now, how does it look for women? Okay, that was all men. How does it look for women? Well, remember what we're going to look at here are women who were 50 in 1982 to begin with. We're going to follow them. And they had to have significant labor force attachment in 1982. They had to have at least, sorry, when they were 50, 52. They had to have at least $10,000 worth of income each year on average. That gives them significant labor force attachment. So here's what this age profile of retirement looks like for men over here and women over there. So women are slightly more likely to have retired at each age. They're slightly more likely to retire at most ages. And they're slightly more likely to be retired and still alive at each age. But the basic picture here is not a whole lot of difference. The male patterns and the female patterns look a whole lot alike. And I think that's pretty interesting. But of course, the selection here is that these are women who, in their early 50s, did have significant labor force attachment. Okay, so the way that they leave the labor force looks a whole lot like the way men left the labor force. And they have a rather similar looking age income profiles. Okay? Now again, each panel here is an age of retirement. And we see the big drop in income for each age of retirement. And we see what happens to income after retirement. Now, you're not just living on a tilt. Do you see something special about what's happening to women's income after retirement here? It's rather upward sloping, isn't it? Didn't see that so much with men, did we? Significantly upward sloping. Why? Let's come back to that. That's a pretty interesting question. Why is it the case? So let's look at these measures of income replacement. This is the first measure. We look at for women now, these 1982 cohort of women. So this is their income replacement 2 years after relative to 2 years before, and they certainly do better by waiting a bit. It's higher than for men. Always higher than for men. If we compare age 65, 66 to 50, 51, remember this is the age of retirement here. So people who retired at 54, a couple of years later, had incomes that were low relative to what they had just before they retired. But by age 65, 66, they're up to over 70%. And that's pretty flat across here. If we wait for another 5 years, their incomes are still higher relative to what it was when they were 50, 54. And if we wait for another 5 years, okay? So these are people now who retired when they were, women who retired when they were 55. They have income replacement rates 90% of what they had when they were, by the time they're 75, 76, as compared to when they were 50, 52. So it looks pretty good for women. But what's going on? Well, we can go through the same exercise for women, and we see what happened. This is for women who retired at age 56 now. And we see what happened along the way here. They also, they retired at 56, have pretty generous pensions. And their total incomes have this sharp upward slope. And if I look at age 61, same sort of thing, lower pensions than the 56 retirees. And if they waited to retire until they're 66, much lower pensions again, but this significant upward slope here. So let me come back to that. What's that about? Well, it's a combination of things. But it's mostly one thing, and that is their husbands have died,
Yeah.
and they're now reporting the income that had previously attributed to their husbands. There's also a bit of an element of perhaps becoming more likely to receive other sources of income. Certainly at age 65, the benefits kick in, but that doesn't explain the continued upward trend. So it's mostly the accounting thing that on the death of a spouse, and that explains a small upward slope for the man and a much bigger upward slope for the women. Okay, now, just to compare men and women, you'll notice the big difference. First of all, they look fairly similar here. This is all for people, this is for those who retired at age 66. They look pretty similar, but if you look at the axis here, the incomes for men are much higher. This is up to 70,000, this is up to 40,000. So the incomes are much higher, but the general shapes and the general stories that go with them, aside from the levels, are pretty similar. And the age patterns of retirement. Now, how does this compare if we look across cohorts? So this is, at the moment, for the 1982 cohort. Maybe it's best to focus, well, let's focus on this bottom one, which is the percent that have retired and are still alive at each age. Here it is for men, and here it is for women. If we take the next cohort, it looks a whole lot like that, okay? 1987 cohort. Take the next cohort, again, it's pretty similar, a little bit different, but pretty similar. And if we wait for the next cohort, we get only a short amount of it, but it looks to be on the same track. So the point that I'm making here is that over time, we have rather similar, we appear to have rather similar information about what's happening to these, to the labor force behavior and to these profiles. Here's the 1982 cohort. Here's the 1987 cohort. We lose the 1987 cohort at age 71 because just run out of data. Okay? So the 1982 cohort, we can follow all the way to 76. This one we can follow only to age 71. But the shapes look to be pretty similar. And then as we go on to the next cohort, we can follow it for only 5 years less, and then still less. But we still do have a fair number of people who have retired in the earlier years, but they've only reached age 61. So we're looking at early retirees here throughout. And then again, if we come back and look at measures of income replacement, here are the various measures. And I'm just showing you here that for later cohorts, the patterns look pretty much the same. So things haven't changed all that much as we look from one cohort to another. If we take the next measures, again, we're getting pretty similar stories. So, all that. Okay. Now, everything that I've said up to this point is very descriptive. And these are just different ways of tabulating data, looking at them and thinking about them. Now, I'm going to give you brief results on taking a more, if you like, sophisticated approach in a way, using some regression analysis, and trying to see what we can understand. Everything that we've looked at so far is just the averages. This is what happens to people who retired at age 57. There were their average incomes at each year by type of income, averages, averages, averages. Okay? But we're interested not just in averages, we're also interested in what happens to people who are low income, people who are high income, different characteristics of that sort. We're also interested in how well we can predict what people's incomes are going to be when they're retired, given their characteristics when they were in middle age, their prime age, in terms of preparing for retirement. So the things that we're able to look at here, clearly we can look at age, and we can look at the age of retirement. We can also look at the income when they were 50 to 52. So we can use that as a control for explaining what their income is going to be in later age. And perhaps importantly, we can look at whether or not they had self-employment income when they were 50, 52. We can look at whether or not they made retirement registered pension plan contributions when they were 50, 52. Excuse me. And we can look at where they lived in terms of province and whether they're in a big urban center or a small urban center. That might be systematically different. And we can look at their language. And the way the language is looked at here is English in Quebec and French outside Quebec as compared to English speaking anywhere outside Quebec. I was going to skip through this. I did make another version of this, and then I brought the wrong version. So the things I would focus on here. These results are just illustrative of the sorts of things we can do with this. But this is for the 1982 male cohort. And here we have the different types of income across the top. So employment income, for example. So even though you've retired, you could have some employment income. You can't have more than 10% of employment income in the immediate 3 years when you retire. That's our definition. But after that, you could earn a bit. You could even earn more than that. Not many people do, but it's possible. So who has employment income? Who has employment income in retirement? Well, let's look at this for people who retired when they were 61, 65. And we'll compare people who had low incomes before they retired, when they were 50, 52, and people who had relatively high incomes when they were 50, 52, at least 65,000 as compared to under 25,000. Well, who's more likely to work? Well, it turns out, with the analysis, that people with low income are much less likely to work, 13 percentage points less likely to work as compared to our middle income group, which is 45 to 64,000 a year, and high incomes 5% more likely. So the gap between those two is about 19 percentage points. High income people are about 19, almost a fifth more likely to be employed, have employment income in retirement than low income people. What are the low income people doing? Well, they're going to be much more reliant on other sources of income. In particular, out here, if we look at the social income, remember what I told you is directed to low income people. These are various types of government transfer payments, not old age security, not GIS, but other things. They're about 15 plus 25, they're 40% more likely to have income from that source. So these are people who are often going to be almost unemployable. They had very low incomes when they were working. By the time they're in old age, they're less able to hold down a job then, one might think, and a big difference between them. Okay, what else can we see here? Well, if you were self-employed, you're more likely to be employed when you're after retirement. If you had EI income, employment insurance income, when you were 50, 52, you're less likely to be employed, and so on. Okay? So we can come up with a number of different things of that sort. Conditional on having retired and having employment income, we see here that people who have low incomes are going to have a whole lot more income on average, about 2,400, as compared to only 981 for people who have high incomes. So if you do work after retirement and you're a low income person, you're likely to get a lot more income than somebody who is a high income person that's just sort of spending a little bit of time doing a cash flow sort of thing, very part-time. One other example here with pension income. If you were a low-income person when you were 50, 52, your pension income is about 8,800 negative as compared to 16,900 positive. A difference here of about $25,000, $26,000 of pension income. So if you're in the high-income group when you were 50, 52, your pension income is likely to be about $26,000 to $27,000 more than if you were in the low income. Which is to say that most low income people don't have pensions, and most higher income people do have a pension. Okay, well, a number of examples of that sort that I could go through, but I won't go through them in more detail. Happy to answer questions. So, to conclude, what can we say from all of this? Well, we first of all can comment on the age of retirement. There's a lot of interest in early retirement, who retires early and so on. It turns out here that using the definition that I've mentioned, the proportion of people who retired young was relatively high in 1987. It's higher in the 1987 and in 1992 cohorts than it was in the 1982 cohort. So early retirement was becoming more popular for people who were 50 in 87, 50 in 1992 than it had been. But by the time we get to the 1997 cohort, that has clearly reversed. And there's a lot of other evidence that I can tell you about too, where people are more likely to stay in the labor force longer now, more likely not to have retired, whether male or female. And if we look at the proportion who have retired by age 66, that proportion has clearly declined over time. 10 points lower for the 1997 cohort than it was for the 1982 cohort. That's a big difference. 10 percentage points lower proportion that has retired by age 66. So there's been a big reversal. Okay, that big trend towards early retirement that we all remember hearing about, largely significantly reversed. The participation rates among older males now and female, older males with the drop occurring, they've certainly gone up very sharply. Income replacement rates, and this is really the focus of it. What we've learned here is that the short-run measures, which are by far the standard measures used, are pretty misleading when it comes to people who retire early. That if we take a longer run view, by the time people are at sort of normal retirement age, mid-60s to later, by the time they're there, the average replacement rates are of the order of 60%, and they're pretty constant as people age. They don't seem to fall off. That rather suggests to me that people do, on average, plan ahead. That most people know about where they're going to end up. It can't just be that by chance each of these successive cohorts, facing rather different circumstances, ends up with a 60% income replacement rate, and that's a very stable sort of thing. So I do think that that people are planning, and the interesting finding here, that I think that income replacement rates do increase with age, but I've explained why that is. Okay, that a lot of young retirees, another finding here relating to accounted pension plan, a lot of young retirees don't take their CPP benefits when they could. They could take them as early as 60. They could wait until they're 70. A lot of people don't take them until 65. And the reason appears to be that those who have retired early often take disability benefits. And you can't take disability benefits, can't pension plan disability benefits, and can't pension retirement income at the same time. So they're waiting until they're no longer eligible for disability benefits. Guess what? That happens at 65. Then they take their pension plan. Okay, employment income. Employment income is increasingly likely among retirees. Big increase between the 1982 and 1992 cohorts, and up to 30% of recent retirees in our study now have such income from employment. So they're retired by our definition, but they still have income from employment. More are And we find that people who are more likely to have earnings, earnings in retirement, earnings from employment retirement, are people who have higher incomes when they were in mid-career. So they're more likely. And also if they were self-employed, or if they contributed to registered retirement plans or registered pension plans. And then finally, maybe almost finally anyway, RRSP income. Only about 10 to 15% of our reference group have RRSP income. The average value is somewhat later for male cohorts, and the male-female gap that's reduced a bit. But interestingly, I think self-employed people are only a little bit more likely to have RRSP income, which is surprising because you think that would be a major source of saving for people who are self-employed but not normally have company pension plans. Okay, it wasn't quite the final thing. Investment income. Later cohorts are likely to have, less likely to have investment income at all. That's falling off. But those who do have investment income are likely to have more of it if they did something in their mid-careers, such as made RRSP contributions or were self-employed. And they're likely to have less of it if in mid-career they did make registered pension plan contributions, which suggests a sort of a trick. You either prepare for retirement in the form of your own investments or you have a pension plan, company pension plan. Okay, and pension income. Now, this is sort of a depressing finding here, but certainly true. The later cohorts of retired 65-year-olds are much less likely to have private pension incomes. 15 to 20 points less likely to have such income. And they get lower average benefits because you do have to live on average benefits. But you're more likely to have it if you did good things when you were younger, with a higher income then, or if you were also self-employed, or if you made RRSP or RPP contributions, and if you didn't have employment insurance, which is an indicator of being a low-income person when you're very young. Okay, that's what I have to tell you.
We have time for questions, but I thought first perhaps if people would like to take a minute or two to help themselves to refreshments, and then we can start into the question period after we've done that. So if anyone wants to, please go. Presentation, I'm sure there are questions out there. I know I've got a couple myself, but I will restrain myself at the moment. So to let the audience go. Yeah.
You had, you showed for self-employed people that there wasn't extra RSP income coming in. For people who end up selling their business, how does that income get reported in what you're seeing here? Is that coming in as investment income, and so their retirement plans, those individuals' retirement plans are more in the capital value in the business that they've run? Or do you know that? Well, the answer is that it's however it's treated in the income tax return. Yeah.
And I'm not sure that I'm an authority on that. I'm sure I'm not an authority on that. I guess
yeah, I think it may come in as investment income.
That would seem
or capital gains, or but something.
Yeah, something in that component.
Something in that component rather than RSP income, and that may be why you're not seeing the tick up in RSP income for self-employed.
That could well be why self-employed people have relatively small RRSP income that they're taking in the form of investment income, some form or other.
Yeah, because they get deferral through their business.
Yeah, that could go. Yes.
So going back to those lovely 3D profiles of ages, we see such a high percentage of replacement income being attributed to pension plans, private pension plans.
Okay.
So looking looking at how things are trending today in the economy with companies clawing back those pension plans, how do you think that's going to play out in the next, for example, my generation, 30s, mid-30s, early 40s, to how that's going to defer potential retirement age for these people, because that big chunk is now going to be squashed or eliminated?
Yeah, I think it might well, well, first of all, just to amplify a little bit on your statement, the proportion of people who have private pension coverage is falling, and the nature of the coverage they have is also deteriorating in a way. People up to this point have had, most of those who have been covered, and it's still true that most of those who are covered have defined benefit plans, so they know the amount that they're going to get is a fixed formula, whereas increasingly new people newly entering plans are in defined contribution plans, and so they have an asset that the value of the asset at the time that they retire, if the stock markets are good, might be here, and if they're not, they might be there, and it's a bit of an uncertainty, certainly a lot more element of uncertainty with that. And then the additional feature is that not only is the quality of the plan deteriorating, but the proportion of people of any plan is falling, especially in the private sector. Public sector, that's not true, but in the private sector it is. And that's the bulk of employment. So how is that going to spell out? Well, I would expect a number of reactions. You're going to react in a number of ways. You would sensibly put more aside from your own resources in preparation for it. You would perhaps work a bit longer than you might if you had a generous plan. Remember what those plans look like for people who retired at 56. If they had much less generous plans, they probably would have retired later. And incidentally, it might be that not only did they get a fairly generous pension income at 56, but there's a bit of a penalty if they didn't take it. And that was often part of the deal. If you don't take it now, you're certainly never going to get any more later. So you work for another 10 years, but you won't be better off in terms of your pension income. And for some of those people, the difference between pension income and employment income is pretty small. So they could stop working in the sense of what they were doing, take the pension and take another job and make up far more than the difference and be better off in that sense. So, but that's not true of the people that I was showing you here. These people really had retired in the sense that they didn't have significant employment income after all retired. At least not within a 3-year window, which is quite a long time. So, bigger private preparation for retirement, working a bit longer, all of which makes a great deal of sense. You'd expect people to react like that. And I can't help but take the opportunity to come up with one of my pet themes, which is, do you know what's happened to life expectancy since the Canada pension plan was introduced? Well, it's gone up. You probably don't have any idea how much. Well, for men, the Canada pension plan was introduced in 1966. Since then, life expectancy for men has gone up by 10 years. But guess how much the age of eligibility for full benefits under the current pension plan has increased? 0. So, if 65 was an appropriate age in 1966, whatever your standard for appropriate at that time, it seems to me it's no longer an appropriate age. It ought to be somewhat older. And obviously, from a social point of view, it's somewhat cheaper to fund it. And people would be encouraged to work a bit longer, which would be in their own best interest from an income point of view. But that's a somewhat separate issue, but it is the response to it. At the moment, people have recently, men in particular, much less than women, men have been spending a diminishing proportion of their lives in employment. Because they're living longer, they entering the labor force later and leaving early. So the proportion of their lives spent working has been decreasing until quite recently that's starting to reverse. But it's still not back to anything like the levels that it was a few decades ago. Yes?
Just maybe a silly question, but who uses the results of this kind of research? Like, who would it be, who would mostly be interested in?
Well, probably academics are always interested in all sorts of funny things, but aside from academics, people who make plans within the federal government and provincial government for provision of income security in the age are decidedly interested.
And I'm just wondering, would this affect people who have to make decisions in terms of minimum wage?
Well, minimum wage is really what you have before you retire, if you have minimum wage. It's mostly, but you know, older people can certainly have employment opportunities at minimum wage. I don't think though that it bears in any very direct kind of minimum wage discussions.
Byron, can I pick up on your answer to Amanda's question? One of the interesting conclusions was the point about whether or not somebody had employment insurance income, because that's a measure really of precariousness or of a kind of disorderly employment income.
Yeah. It means that when you were 50-52, you had some employment insurance income, and if you did have such income, yes, it's an indicator that.
And we know from other measures that in fact now work is people are just a lot more mobile, much more likely to be laid off, be downsized, and so on because of various kinds of changes. But that would seem to interrupt your ability precisely to save money via RSPs or other forms of investments, and that they're already relatively low to begin with.
Yes.
One of the measures the federal government has, one of its trial balloons has floated, is a kind of a way to try to enhance individual RSP type investments, but on a kind of pooling basis. Because I think as these data show, that when we invest individually, on average, people don't make that much out of it. Is that a feasible alternative, do you think, given also the decline in, particularly as you say, private sector pension plans, but also a kind of stagnation, perhaps, slight deterioration even in public sector private pension plans?
Well, there are quite a number of variants on what you just suggested. One is to increase the income range to which the county pension plan benefits would apply. So at the moment, as I mentioned, the maximum benefit you can get is 25% of income replacement, 25% of what you had before you retired. That's the ceiling. And it applies only to people who have up to average earnings. If you have more than average earnings, your percent replacement declines. So an obvious possibility is to make that a more generous plan. It could, of course, mean that people are going to be contributing, not necessarily more as a percent of their income, but they'd be contributing on higher incomes. So people who have more than the average income would contribute to that, and it would be a way of preparing for income security.
Because some of those OECD countries that you mentioned at the beginning, they really have almost entirely public pension plans, right?
Yes.
Private pension.
Well, when the public plans replace close to 100% of your pre-retirement income, there's not much incentive to save beyond that. For most people.
But is that feasible, given that sources of pension income from private sources, either private pension plans or personal RSPs, savings, and so on, that those seem to have a dubious future?
Is it feasible to increase
to move
the
more
coverage
and
of
more
the county pension plan?
to a kind of predominantly public pension plan for everyone?
Oh, I think it's entirely feasible. And we've got a number of countries in which it's demonstrated to be very successful. Netherlands is one. And there are a number of European countries work very well. I think you do have to be concerned with the details of it, very much concerned with the details of it, but I think it can work. Certainly it could work to provide a somewhat higher level of income replacement than is the case in Canada. But let me emphasize again, though, that we do have this really quite successful way of targeting low-income people with the income security programs in old age. And that's very important because these are people, low-income people are obviously in very precarious existence, and there's not a lot you can do about it in old age unless you have that type of support. So it's important that be generous, but at the same time, you could increase the average replacement rate for people who don't have just really low incomes, but somewhat lower incomes. Steve?
There were some numbers in the regressions that flipped through fairly quickly, but if I saw them correctly, it looked like the low-income cohort received, or it took more in no, slightly after this, there. So for those with employment income, at low income levels, investment income is significantly positive, and at high income levels, investment income is significantly positive. If I go to the third last column there.
Sorry, investment income, yes. Yes, I know that.
And that
it's interesting that you caught that. This is a very peculiar result.
Yeah, and what went through my mind was that I'd missed a negative sign there when I looked at it first.
It certainly went through my mind. But no, this, for some reason that I don't understand, among males who retire between 61 and 65, low income, they're likely to have, on average, a fair bit of investment income. Among those who had employment income, it's limited to, sorry, among those who had investment income. Now, just if I step back a bit, yeah, they're a little bit less likely to have investment income.
But if they have
among those who do, we've got this funny result. That's an odd result, and I don't have an explanation.
Okay. Another kind of unrelated question. I think I know the answer to. Is there any way in the data that you have to make the analysis separately for either individuals or households with where at least one of them is a public civil servant? Because you mentioned the difference quite starkly of pension participation for those in the public sector rather than relative to the private sector, and that would be interesting.
It would indeed. Remember, though, the restriction here is that you don't know anything that isn't, researchers don't know anything that isn't in the income tax return. And the income tax return does a very poor job of, at least in the records, do a very poor job of recording employer.
Does the T4 have something on it like pension adjustment or plan registration number that might be a way of linking to that?
The only thing that we know that I can recall is whether or not this individual tax filer reported making a registered pension plan contribution.
Yeah, that's...
So if your employer paid the whole thing, then we wouldn't catch it.
Yeah, that doesn't necessarily tell you whether it's public sector,
No,
sector or private sector. Okay.
And I think we're not able to.
Yeah, no, it's too bad.
It is too bad. It would be interesting to be able to do that, but I think we cannot. Okay.
Well, are there any other questions? Well, thank you again very much for a very interesting and informative talk. And, I'm sure it's given us food for thought for those of us for whom it's not too late.
Never too late.
Before you depart, just a couple of other notices about forthcoming events that Gilbrea is sponsoring. The next talk in this series, Contemporary Issues and Aging series, will be on April the 11th. Professor Randy Jackson is giving a talk titled Exploring Resiliency and Wellness Among Older Two-Spirit Men Living Long-Term with HIV in Ontario. What time was that?
Same time, 1:30.
Same time, 1:30, same room. Tomorrow evening, the Carl Kinanen lecture is being given at St. Peter's Hospital. Starts at 7:30. Our guest speaker is Professor Pia Kontos from University of Toronto. The title of her talk is Exploring the Social World of Dementia. And then on April the 19th, Professor Andrew Joshi, who was at the talk earlier, is giving a one-day workshop. The title is Case Management, Integrating Care for Diverse Older Adults. You can contact Gilbrea for any more information about any of those three events. Thank you again for coming, and thank you, Byron, for your talk.